Two men walk away from the same bank account with the same $50,000. One of them buys a house. The other one buys nothing you can touch. 20 years later, they are both millionaires. But only one of them actually slept through the night. Let's call them Daniel and Ryan. They are the same age. They earn the same salary. They live in the same city. The only difference is what they each believed about wealth. Daniel believes that real assets are real wealth. He puts that $50,000 down on a $250,000 property, takes out a 30-year mortgage at 7%. His monthly payment lands at $1,330 a month. His tenant pays $1,800. On paper, that gap looks like $470 in his pocket every month. Daniel tells everyone at the dinner table he figured it out. Ryan does something that is almost embarrassingly simple. He wires the same $50,000 into a total market index fund, sets an automatic contribution of $300 a month. Then he does nothing. His friends ask him what he is investing in. He says index funds. The conversation ends. In the early years, Daniel feels like he is winning in every way that matters. Rent hits his account on the first of the month like clockwork. He can see it and he can touch it. He is deducting mortgage interest and depreciation from his taxes. Every mortgage payment is quietly building equity. Everything about this investment feels like proof. Ryan logs into his brokerage account once a quarter, watches a number go up, then slightly down, then up again. Year 1, his $50,000 becomes about $55,000. There is nothing to drive past and nothing to point to. Just a percentage on a screen that nobody at the barbecue wants to hear about. But social proof and financial math are two completely different games. Here is what the first 3 years actually look like for Daniel. Gross rent collected is around $64,800. Mortgage payments total $47,880. The surface difference is about $17,000. Then the real world shows up. Property taxes run $3,000 a year. And insurance adds $1,500. A water heater fails for $1,200, and a roof leak costs $2,800 to patch. 1 month of vacancy means $1,800 in lost rent. Cleaning and relisting costs another $600, because Daniel is managing the property himself to save money. He deals with late-night texts and Saturday morning repair coordination. After 3 years, his actual net cash flow sits somewhere between $2,000 and $4,000. And that miserable number does not include a single hour of his own labor. Meanwhile, Ryan has contributed $50,000 up front, plus $10,800 in monthly deposits, at a 10% average annual return. His portfolio is already sitting near $76,000. 0 hours spent and 0 emergencies handled. But here is where Daniel still has a real structural advantage. His $250,000 property has appreciated 3 to 4% annually. His equity position has grown to roughly $55,000 to $65,000. He used $50,000 to control $250,000 in assets. That 5-to-1 leverage ratio is the one weapon that passive stock investors cannot replicate. This is the core tension nobody explains clearly. Real estate multiplies your starting capital through borrowed money. Index funds multiply your returns through compounding time. Both are legitimate engines of wealth that run on completely different fuel. By year 5, the gap between projections and reality becomes impossible to ignore. Daniel is on his 3rd tenant, and the roof required a full replacement at $8,500. A plumbing emergency ran $14,000. $100 in vacancy left him with full mortgage obligations. He has raised rent to $1,950, but his property taxes and insurance have risen with it. His actual cash-on-cash return is hovering between 3 and 5% annually, not 15 to 20% like the number he told people at the barbecue. Ryan, by year 7, has done nothing except not sell. His portfolio has grown to somewhere between $135,000 and $150,000. He did not pick individual stocks or time a single entry. The compound curve is beginning to bend upward in ways that make the early years look irrelevant. The first 5 years feel like nothing is happening, but the next 15 feel like the machine runs on its own. At the 10-year mark, Daniel's property is worth roughly $335 to $350,000. His remaining mortgage balance sits near $166,000. His equity position is approximately $170 to $184,000. But over that same decade, after subtracting interest, taxes, insurance, maintenance, and vacancy, Daniel has spent an additional $20 to $35,000 beyond his original down payment. Ryan's portfolio at 10 years sits at approximately $165 to $180,000. Total money he ever put in is $86,000. Everything above that is pure compound growth. And he has never once hired a plumber or taken an emergency call. At the decade mark, they are surprisingly close in total net worth. Daniel may be slightly ahead because leverage amplified his appreciation gains. But Daniel also concentrated his entire investment into a single asset, in a single zip code, and spent hundreds of hours operating what is functionally a part-time business. Ryan diversified across thousands of companies across the global economy and spent that same time doing whatever he wanted. The story separates completely at year 20. Daniel's property is now worth between $450,000 and $500,000. His mortgage is paid off, and his equity stands somewhere between $400,000 and $500,000. He has collected rent for 2 decades. But after accounting for maintenance cycles and tenant turnovers, his actual net profit from cash flow above all, real costs, lands between $40,000 and $80,000 total. Ryan's portfolio at 10%, average annual return with 300 monthly contributions, has grown to approximately $420,000 to $460,000. His total lifetime contribution was $122,000. The remaining $300,000 plus is pure compounding. No debt, no tenants, and no 2 a.m. calls about a burst pipe. In raw net worth terms, they are in the exact same ballpark, both somewhere between $400,000 and $500,000. But how they arrived there could not be more different. Daniel worked for his while Ryan waited for his. Daniel carried debt concentration risk for 2 decades, while Ryan carried volatility and nothing else. And here is the number that changes the entire equation. If Ryan had increased his monthly contribution by just $200, bringing it to $500 a month, his 20-year portfolio would land closer to $550,000 to $600,000. Because more fuel earlier creates disproportionate outcomes later. In real estate, scaling up means another mortgage, another property, and another layer of complexity. Now let us be precise about where stocks actually fail. Market volatility is psychologically brutal, in ways that spreadsheets cannot capture. In 2008, the total market fell roughly 37%. Watching $150,000 in your portfolio become $95,000 in a month is a gut punch. The majority of individual investors panic, sell near the bottom, and lock in real losses at the worst time. Index funds also produce no monthly income stream. Dividends on a total market fund run roughly 1.5% to 2% annually on a $150,000 portfolio. That is maybe $200 a month. That is not replacing anyone's income on its own. And index investors have no leverage to amplify their starting capital. But real estate has a tax architecture that passive investors cannot access. Depreciation allows landlords to deduct the theoretical decline of a building's value from taxable income, even as the property is actually appreciating in market value. House hacking can reduce your own housing cost to near zero, while simultaneously building equity. And 1931 exchanges allow investors to defer capital gains taxes indefinitely by rolling profits into new properties. The real lesson from Daniel and Ryan is not which asset class is superior. It is that neither of them sat down before making their decision and mapped out all the real costs, not just the financial costs, but the time costs, the stress costs, and the behavioral demands. The actual trap is selecting either path based on a headline or a podcast clip without ever running the full 20-year projection before you commit to either path. There is one question worth asking anyone who claims to know the answer. Did you include everything? the maintenance cycles and the panic sell, the eviction risk and the market crash psychology, the depreciation benefit and the compounding curve, the hours spent managing and the hours freed by not managing. Because the answer that includes everything is the only answer, actually worth building. A 20-year financial decision on